All right, let's get started. So welcome everybody. So of course, this morning we got information from Tesla about their deliveries and production. They hit 387,000 deliveries, 433 production. The conversation today, we can expand it beyond just, was this a terrible quarter? Why did these numbers show up like this? Nobody was able to hit their targets for deliveries. But let's also talk about, how does this look for Tesla ongoing Q2 and onward? Some people are saying out there that the sky is falling, and this shows you that the EV, dream is just a fad, and it was a one-time blip. And in fact, the EV growth story is over. Tesla is going to continue to face downward trends for the next year because of people not wanting to buy EVs anymore. And but then there's others who are saying, this is just the auto business, and we should be looking at the FSD and energy and the bots, and those are the things that we should be caring about. So let's get you started first, Jeff. I know we had you on a live stream, quick reaction earlier this morning, and you explained specifically why the production was higher than deliveries significantly. But does anything you said earlier this morning, has it changed? Has your thinking changed at all?
Yeah, there are some new things. Actually, as other automakers have announced, and maybe we'll go through that a bit later, Herbert. Um, it's interesting to see what we're seeing from other automakers. I've been able to dig into parts of their report, but not the full thing. And you really need to, when you look at a report and you look at shipments, you got to look at like what are they shipping. You got to look at like what's happened with their inventory position, what's happened year on year, what's happened sequentially on quarter. And you'll definitely see some trends, of companies that are more dependent on China versus less dependent on China. Um, you'll see, inventory is in general grown in the United States across all automakers, but specifically, it's grown, and so a lot of these companies that are taking credit for maybe U.S. growth, like GM was, well, it all came in the form of shipping from their factory to a dealership, and it's sitting in inventory. So there's real growth and not real growth. But in terms of Tesla, um, you know, it looks like from an inventory perspective, one of the new things is just calculating, DOI, and there's somewhere on the order of 90 some thousand units leaving Q4 of last year, and it looks like they added another 40K and change this quarter. So their DOI is going to pop up into the probably mid to high 20s. And I think that's okay. I think, especially if it's kind of a one time thing. By the way, I've been in the camp of, I think their DOI is actually too low. This is days of inventory. I actually think they don't carry enough inventory, and I can explain that in a bit. But I think one of the things, since we spoke this morning, and I encourage people to go view the live stream, because we just literally responded live to the P&D earnings and tried to break down the reasons that Tesla gave and provided, and provide some sanity to that, sanity checks on things, as well as some of the other reports coming in from other auto vendors. But then, yeah, this DOI thing came up. I'm not concerned right now when I look at it, but we need to understand more from the company and where they see it going. I've often thought that they need to grow their DOI a bit as they change their delivery model of vehicles. They're not going to be on a build to order model, at 600,000 units, 700,000 units a quarter, even at the current run rate. I think it's difficult to maintain a build to only primary model. So they're going to need to get models in the right place at the right time at the right inventory locations. And just for people to understand, like, I think at minimum, you need a couple of weeks of inventory in, it's called available to sell inventory. Because remember, Tesla's inventory is a combination of units that they've just produced and they're in transit in the system. Like they're going from a Tesla factory to a location to be available to sell. And then there's the stuff that's available to sell. But you see the whole number, you see all of that. But when you see, 100 some thousand, let's say just pick a number, 100,000 units, all 100,000 units are not available for purchase. I want to be clear, they're not available at the time. And when Teslas were at least talked to analysts about this in the past, and most recently, I think in Q3 they talked to them. They said, "Hey, about half our inventory is in transit." That's, to me, that leaves them only like a week of inventory in stock, and that's mainly in our terms, that's usually you're stocked out then in most locations. So I thought that they would need to get at least another week of inventory, which means they would need to have like around 14 to 16 DOI just available to sell, and then probably another week to 2 weeks in transit. So I'm comfortable with low to mid 20s and DOI for them to grow their business. So that's, if you ask me, Herbert, what's the one thing? I think that's the one thing. I think you'll hear noise about inventory, but Tesla does not have an inventory problem. Comparatively, they're in great shape. And then there's some people who are trying to compare like inventory and valuation of the company, and they don't. They are there. Is definitely a connection to the balance sheet and cash, but this isn't a problem what Tesla's doing. In fact, I think, like I said, I think they've needed to do this. And what else? I think finally more, it's kind of like looking ahead to Q2, and what would make this situation, like what's the current course and speed? Like, did they find and fix problems in Q1? Like, so now we've rerouted for Germany, and now that offset is permanently in the system. It impacted weeks available to sell in Q1, but now that's been biased out of the system and it's just in there. Eventually, that offset will come out, and that will actually help um, supply. But now it's in there, so now it shouldn't impact Q2. So that's one thing off the board. We shouldn't have our factory power system set on fire in another this quarter, hopefully. So that should be another thing that's resolved. And then the Model 3, the question is have they solved the problems, and do they have the Model 3 running at peak run rate? Remember, this is a car in the US that they do 55K a quarter on. And we don't know what they did in Q1 in the US. There's some people think there's very few deliveries. We don't know the exact number. They don't split it out. But maybe we'll get more data soon as some of the registration data comes out. Maybe we'll get some more data on that. But did they solve the Model 3 problem? Because you got to put them on a hand. It's like a poker terminology. Like, you got to put them on a hand. And so if they do 55 or so thousand, and this is a new product, you'd think they were probably planning demand of 60, 65, 70,000 of the new Model 3. And then what if they only did 10K? What if they only did 15K? Well, have they solved that fundamental problem, and do they have the run rate where they need it to be? I'm a little concerned. I don't know if they have. Because it looked like it was bifurcated between rear-wheel drive cars and long-range cars. It looked like long-range cars had the issue, had the long offset, and you can order a rear-wheel drive refresh Model 3 and get it pretty quickly. So I think the other thing that's happened, to answer your question, Herbert, is just the look ahead to Q2. Have they solved these problems? Is there an underlying demand component to think about? Is there softness in China? It looks like we're only 2% off the prior quarter. It's either sequentially or year on year. It wasn't like there was a huge shortfall, but China may be one to double click on from a demand perspective. The other thing in Q1 for the US, everybody's looking at the point of sale credit, but that didn't go into effect until I think like the third or fourth week of the month. And remember, that's a thing where it wasn't like a light switch where it turned on at every Tesla location. It was one of those things that it had to be like each site had to be like qualified to bring up and to be able to perform the credit. So I don't even know how that played out. But I think they just started bringing up the first several places in the third or fourth week of January. So you didn't have all 12 weeks available to sell of the tax credit in the US. So what component was that? And has that been fully solved? And are we lit up everywhere with the tax credit in Q2? That obviously could be helpful. And then if there is some inventory data to look at, is there something going on with a particular model? The one thing I did go through this morning is the whole concept of inventory timing. And like when you have an inter-quarter issue and you solve it, or you partially solve the issue, you're probably stuck with the wrong inventory at the wrong time. Everything's sequenced throughout the quarters. Like they build, like in the first month, there's destinations, like there's furthest points destinations that they go to. Like they have a plan for how they build their product and how they distribute in the quarter. And when you have these interruptions or you have these supply shortfalls, You don't just turn it back on, then everybody gets the demand exactly what they want at the same time. And then you end up getting stuck with inventory. Again, it's a timing issue, and you work it off in the following quarter. But there's definitely that component happening too. So there's a number of things. It sounds like a bunch of excuses. At the end of the day, some of these things are in Tesla's control, and some of them are not. The ramp up of the Model 3 that's in Tesla's control. I don't know what the root cause of the issue was. If there was a natural disaster on the outside, maybe they would spell that out. But to me, that's within their control, and that's execution that they need. They need to ramp faster. They need to get product cut over and into production faster and in supply faster. So there are definitely things in their control, and there's things that are outside of their control. But finally, when I read the Tesla P&D, they're calling out supply. They're not calling out demand. They're not calling out interest rates. They're not calling out China softness. They're not calling out that. They're calling out supply, which I found interesting.
Right.
Come up for air.
Yep, no, that's great. Thanks you. But I do have another question for you, Jeff, because the production was about 50,000 more than the deliveries. And then you were estimating that the Model 3 ramp cutover, that could be around 40 to 50, just that alone. The Red Sea and the Berlin arson could be 10 to 20,000, but the China micro could be 10 to 20. Do you have a sense of where you're landing now? Or where do you think this came from?
Yeah, those are I would call those delivery shortfall estimates of, yeah, I mean the Model 3 refresh. They normally do 55, 60K in the US, and we don't know the number. It sounds like it's a very small number. So that's why I put it on 40 or 50K, maybe shortfall there. And everything's kind of in a range. And then yeah, there's people that are debating me on the Red Sea reroute. But it looks like Berlin was growing, but not too much above 60 or 70K a quarter. So if you break that down, you're talking 10 weeks of manufacturing. You're talking roughly 6K a week. So I just put that on like the 10 to 20K range. And again, these things aren't perfect. Like when you lose a week of supply, remember that when you start resupplying a factory, the factory has to. It's not like a light switch where you flick it and everything turns on at the same time. Think of it like a fluorescent one where it kind of like takes time to warm up, and you got to re-ramp the factory. So just because you had a 2 week inbound supply outage, you may have a 2.5, 3 week total delivery outage. So that's why I put that on kind of 10 to 20K. And then China softness. Again, that one I'm a little bit like, okay, it's a cause, but Tesla's got to figure it out, whether it's incentives or whether it's some other, they've got to figure out ways to sell more cars. So, but it does speak to there is general softness in China. Other vendors are seeing it as well, but to differing levels. But yeah, if I pinned all those three issues together, you had 40 to 50K for the Model 3, 10 to 20K for the issues in Berlin. You also have to add in the power outage issue is very interesting. That happened in the beginning of March. And for Berlin, remember Berlin is building for, Germany and the rest of Europe. And what they want to do in the beginning of the quarter is they want to distribute as much as possible to the furthest places as possible. And then as you get closer to the end of the quarter, they want to be able to distribute more locally. But they had the Red Sea issue before that, so they were shut down. So I don't know who the distribution points were at that point in time, but basically, if you have an outage, factory outage in the beginning of the third month of a quarter, then you come up in the middle of that third month of the quarter, you're basically bringing your factory back up right at the supply cutoff point where they can't build anything that's going to reach a destination point and be revenue recognizable, meaning they could count it for a delivery. So sorry, this is some of the wonky stuff that goes on, inside of supply chain. But I think it's important to explain it because people just look at the big numbers of like it's 386, it should have been 420 or 440. It's why did they build 400 and 30,000 cars? Why did they build 45,000 more cars than they ship? And what I'm trying to explain is there's all these different timing offsets that occur. And in a normal functioning quarter, when everything's running smoothly, like they have a plan and they execute it and they can get it pretty close and tight. And Tesla runs 15, 16 days of inventory. very tight ship. I think almost too tight. So with these issues, it really throws a bottleneck or monkey wrench in, and it creates these bottlenecks. And then you have this thing of stranded inventory, where again it's stranded for a point in time, but it's something they'll be able to flush out. So as long as there's nothing here happening from a macroscopic level, I don't see why they won't be able to take their inventory down across the second and third quarter of the
Yeah,
year.
I love your explanation. Actually, I'm now over the last several, 8 hours today, I've started to understand what you're saying and believing it. Because initially, when I first reacted to it this morning, you remember that I was thinking that it was China macro must have been the reason, primarily because BYD's first quarter results of 300,000 electric vehicles was a complete, like, you guys are worried about Tesla falling. BYD fell by 44% from Q4. They had to crash and burn. So, why is this? Is it because of China macro? But the last March month of China for Tesla was very good. So I actually think it really is just what you were saying, some numbers. Now, I know that we're talking about P&D numbers today because that's the information that dropped this morning. I will want to change the topic to expand it a little bit later. I'm going to ask you guys the question. Would you rather have invested in Tesla in 2019 prior to its 20x run up, or do you want to invest in Tesla today? And we'll compare those two scenarios. But let's add some other voices here. Xander, did you want to jump in?
Nothing specific, but what kind of question is that you're going to ask?
Oh, just wait, just wait.
We
You'll love
we
this one.
we we
You'll
would
love it.
want I would want both. I would love invest
Yeah,
in
yeah,
2019 and then
yeah.
sell at 400 and then rebuy it at 100, of course.
You'll love it, love it. Okay, so why don't we get started with Christian? I know you have a completely different view of this whole thing. Tell me what you're saying.
No, hey guys. I mean, I don't have a different completely view. I'm just using some logic and some experience to just make some judgment
Is he
calls.
talking?
So, can you hear me?
Yes, I can hear you.
Okay, maybe Jeff can't. Jeff, I heard Jeff. He did a great synopsis, and I'll never argue with Jeff on supply chain. But the only thing I'll say is, in the press release, it said partially. So to me, Tesla was partially talking about Model 3, production troubles, the Red Sea stuff, all that supply end. But they did said partially. So I do think there is a bit of a demand component, and that could be what Herbert was talking about, a little bit of softness in China, and I think a little bit of softness in the U.S., right? I still think there is, for a good reason or a bad reason, a demand component to Tesla, because we do now have the 7,500 credit. We have cut prices a lot. Tesla has done that. So I think it is a little bit for a growth company, to not be able to move the units that they need to move to be a growth company. I think, and this is just we're just having a normal chat. 1.8 million, I think, with this first print in Q1, I think that's in jeopardy. And I think what Tesla is doing now, and this is just my opinion, I think they're changing their strategy from lower prices to move volume to make sure they grow like they did. 1.8 was higher than the year before. I think they're taking a little bit of different tasks. So I think it'll be interesting to see over the next few weeks. Do they cut price to move units again, or do they hold pat on price, knowing they really didn't get a lot from reducing price on the growth, and they try to, kind of protect margins a little bit and kind of just keep working on FSD and try to drive that from the margin perspective rather than just cutting price on card to move units. I think there's a little bit of a strategy going on here. And I think Tesla has to make it really clear on the Q1 call what their strategy is so investors could know, like, here's what we're doing, here's what the rest of the year looks like, and kind of lay it out for us. Because right now, and I've talked about this before, we're kind of a little bit in no man's land. Tesla had a strategy of cutting price, and I understand that, to move units, but it looks like they're not moving units now, right? Quarter over quarter, first time in a long time, or maybe forever, that they've missed year over year like this. And it was a significant miss. So I think management really has to come up with a strategy and articulate it well to investors on the Q1 call to restore some confidence and kind of just go forward from there. So yeah, loved your earlier talk, Jeff.
I was just going to say, so what if you, I agree with, by the way, most of what you said, just you say not moving units, but if they didn't have the supply issue on the Model 3, I mean, it's pretty rational to say like a brand new product that's very well received, they would have been able to ship the 50K and recognize units on that, and that would have taken them, call it the maybe 420 or something. And then, if they didn't have some of these other issues, major issues, maybe there's they're in the 420 to 440 range, and now we're not talking about a horrible Q1. So that's what I'm saying. So I don't disagree that there could be a demand component. I've never said that there couldn't. In fact, I called out China for that for sure. There could be other regions too, but it looks like Europe was pretty strong. It looked like China closed strong. It looks like the China economic metric from March look stronger. So anyway, just I'm saying we could be having a completely different conversation if they didn't have these supply issues to deal with. And again, I do think there is it's not binary. I think there is a demand component as well. But I think you can put a number on the supply issue, and maybe they will be able to put a number by the time they have the earnings call, like, hey, we missed this much in supply that we could have shipped and taken revenue recognition on.
Yeah, and I agree with you, Jeff. And I think you said it well. Like, we have to know that, right? Is it solved? Like, how is this going to linger into Q2, or is this fixable? And
Right.
and we don't know that at the moment. So to your point, I think you're making a great point there. We just don't know. So yeah, we're going to have to see. I guess we'll know a little bit more on the call. But yeah, that I agree with you.
Yeah.
Okay.
And then what do you do with that information then, Herbert? And then like, okay, well then maybe it's not the end of the world. Now, the other thing that's changed, and this may get a little wonky, but just follow me down this the rabbit hole. Last year, Tesla was multiple years away from making they say they're between these two growth waves. Well, last year they were, another year added to that between those two growth waves. So they had to cut price, keep their factories growing, keep their factories utilized, their supplier factory. That's how they could take their COGS down. They can take the whole cost structure down. And now, here's a theory I have, which is there's still room to go on COGS. Like, the 35K or so, they're probably at 34K on just 3 and Y. And probably even a lower number than that, to be honest. And I think they probably have at least another 10 to 15% to go on that and longer. Like, they're going to be taking costs out in perpetuity. But just follow this logic. Last year, they had to keep cutting prices, be able to keep demand up, keep supply, keep everybody utilized so they can take their cost structure down. And they did that. And so now they're in this point where the game actually changes. Now you've RFQ'd, which means now you're in supplier selection mode and you're in factory selection mode and country selection mode for the 25K compact vehicle. And now it actually changes. Now it's like, instead of supplier like, hey, I'm gonna get you units, I'm gonna cut price, I'm gonna make sure you're utilized, you need to give me cost reductions. Now it's like, if you want a ticket to ride on the next platform, which is probably going to be the size of our whole shipping volume, then you're going to have to cut. You're going to have to stretch for me on 3 and Y this year and Cybertruck, and then that would potentially be your ticket to ride on the compact vehicle, and then maybe even the bot. The bot has to be getting close to RFQ as well too. So now I think the game changes, and the game changes from we need to drive utilization up and so forth. Now we're a year closer to basically putting this stuff into production next year, and now it's like, okay, suppliers and partners, like, you got to stretch with us. We're going to keep our volumes and our pricing stable, because I don't think they want the 3 and Y to go down too much further, because the compact vehicle is not going to start at 25K. It's going to be at a higher cost structure in the beginning, and they're probably going to structure some packages to sell it. So my point is like, you're getting to the floor of the current vehicles, which I still think there's more room to go over the next year, and then you're going to start at a higher ceiling on the next vehicle. I think they're done, for the most part, cutting price. And I think now they've switched this whole game of like, if you want a ticket to ride on the next product supplier partner of Tesla, then you've got to come to us with solutions on the 3 and Y today. That's what I think is happening. That's what would happen in my experience. So, and that's why, why else are they not cutting? Why did they not cut prices in March?
Yeah, I'll have to disagree. We'll talk about this. I think they're going to want to cut prices. They want to ship units. They're going to sell everything that they make because robotaxi is coming, right? And it's coming sooner than when we are all thinking at this
Maybe.
point. So let's ask just get Hans and Emmett on here, and then I'll ask my question for all of you guys. Emmett?
Long-term investor, my perspective is from that standpoint and looking at things pretty simply. At this moment, I'm real pleased about two things. The production numbers were higher than I expected, so I'm very great that they've been performing as a company. And two, the stock is on sale, so I think that's awesome. In terms of headwinds, we're going into the quarter with 4 headwinds that I was focused on. Jeff added a third one with the details to the supply chain, which I really appreciate. But the 4 that I'm mindful of are the fire, the challenging economy in China, the switch over to the Model 3, and the high interest rates. The fire they recovered from very quickly, so that's not really an issue for Q2. The interest rates are still an issue. The changeover is getting better, but it's going to have some level of impact in Q2. But generally, I'm most worried right now about the interest rates and how fast we can get the production going. But I'm excited long term. I'm still as stoked as ever. I'm glad they were able to get their production as high it was, even with all the supply chain issues.
Wonderful. Thanks, Emmett. And then Hans?
Yeah, I mean, honestly, there's only one thing that matters for Tesla in the next quarter, and that is what is the progress of FSD and what, if any, changes do we see to pricing strategy moving forward. Where we're at today, I'm a little bit surprised that we are already in free trial, and the more I've thought about this, I think it has come before I would have guessed from a safety standpoint. I don't think the safety threshold is really to the point where they can aggressively do, creative pricing actions with it. I think that the free trial is probably something that they went ahead and entered into because they actually want more human data. And so I don't think that we are quite to the point yet where they're ready to try and really just blow take rate out of the water. So that's what I'm watching this quarter, is to see, can we get to that point by the end of Q2, or, are we looking more towards the end of the year? Is that something that pushes out? But yeah, that's really like SaaS revenue re-rates the entire company, period. And everything else is, just marginal effect on Tesla's pricing compared to what FSD does in the long run.
I want to share 2 quick things. One, I don't want to drop the point that Jeff made about the $25,000 car not costing $25,000 when it first comes out. Great point, but it could actually have a sale price of $32,500, and it would still be a $25,000 car for most consumers. So I think that's important to remember on that point.
Okay, so we spent the last 30 minutes talking about the production delivery numbers that dropped this morning. We examined it in all sorts of ways, why it happened, and it's a big bad quarter for us. But then the question I want to ask you guys, right? Would you think it's a terrible friggin' time right now for Tesla, right? Because here we are, right? January of April 2024. You got the story is that it's no longer a growth company. The auto business is falling dramatically, no longer 50%. The margins have crashed. Here's a good example of the Q1 is just we're no longer able to deliver all these challenges. Would you rather invest in Tesla today, or would you rather have invested in Tesla in 2019? So in 2019, let's say here, November 2019, the stock was at $23, which is, split adjusted. And by February of 2020, so that's like just 4 months later, it was $45, so doubled. And then by January of 2021, it went to $293. So it was like a 15x at that point. And then, of course, if you carried forward, it still continued to go up. So obviously it grew. But in 2019, you still didn't know that this company was going to succeed, right? You kind of understood at that point, the Model 3 is seen as successful. They were able to right shift the scenario with the factories, and everybody was very excited about electric vehicle growth. That's why the stock went up. Today, people are going, oh my God, it's no longer the electric vehicle story. And then I will challenge you and say, of course it still is. I just did a story with Hans. We'll publish this tomorrow. 31 countries are now hit the 5% tipping point of electric vehicles sold. It's only in the US where it's stuck at 8% and not growing as fast as all the other countries in the world, other than South Korea and the US, which is lagging. Typically, once a country has hit 5%, it skyrockets to 15% and to 30% within 3-4 years. So that's what we're going to see happen in EVs across the world. This is not going to stop. This is just because you see a slowdown in the US, doesn't mean that this is something that's happening globally. Then you've got the compact car coming. So we were excited about the Model 3 ramp in 2019. The compact car is going to be, double, triple that, because it's going to be double the amount that you can get from Model 3, Model Y. You got Robotaxi. You got FSD version 12 now showing you that it actually has a path to Robotaxi. And you know how big that is in terms of, forget the auto business. Look at the Robotaxi. You got energy. They finally dropped another quarter of results for energy. Energy is going to double by the end of this year. It's already 9% of the revenue. That's higher margins. It will double by this year. And then 2 to 3 years from now, it'll be even bigger. And then that's very quickly. I mean, if everything stayed flat the way it is with auto, energy will match that within 5 years, right? Then you got the bot. So, let me ask you the question. Which one would you rather invest in, 2019 or today at 2020 with this incredibly bad news of what happened to the auto business this quarter?
Well, if I could just jump in, Herbert, I think you did a great thing there, laying it out. I think the obvious answer is 2019, because I talked about this before. I'll try to be brief so everyone could go real quick. 2019, I remember being on Twitter, now X, and it was a question where the shorts were so emboldened, the stock was so heavily shorted, but you could see, if you're just doing some basic research, that Tesla was growing like crazy. You could see China, the growth of the factory, but all you heard on the major networks and from all the major big-time investors was, this is a company that's going bankrupt, and this is not worth anything. Essentially, it has zero value. But you could see by just doing some basic research that they were growing units like crazy. It wasn't like a pipe dream. Like you could see it. You could see China. You could see the early ramp of China just exploding. And then you could see the turn to profitability. So to me, it was almost like I know you think it was risky, but for me, I think in 2019, especially after Q1 and into Q2, Q3, the risk became almost zero, because you could see the growth, but none of the big money saw it for some reason. Either they weren't on Twitter or whatever they were doing. So to me, it was an easier story. And of course, the valuation was much less. So the upside that you had relative to the risk, because you saw what was happening and the media had it completely wrong, for me was a no-brainer and was much easier. So again, just my opinion, I think now, and I think Hans made a great point, it's less about the EV business, because essentially right now the EV business is slowing and maybe flat growth. So for a growth company, that's not great. And I agree with you, compact will help, but we're probably not seeing compact till 2026. So that gives us almost a year and 3 quarters of trying to navigate all this. So I agree that Hans, that like the most important thing is, can Tesla get FSD to the point where more people get it and you can get more revenue through this software? Because I think it's going to be very challenging to do it just through the hardware, because the units aren't going to be there. And I don't think the revenue growth is going to be there because of the price cuts that have already hit. So short answer is, I think it was easier in 2019. Now, is there a great opportunity now? Yes. But I think it's harder just because Most people, now maybe there are people that are FSD experts and they know it's absolutely going to happen and they know, roughly it's going to happen in the next few years. I'm not that smart. So for me, it's a harder thing to say, this is the best time to do it because I know FSD and robotaxi is going to happen. To me, there's a probability it'll happen, but I don't know for sure, and I don't know how long it'll take. So for me, the story's harder now than it was in 2019. But it was a great question, Herbert.
Who wants to go next?
I mean, go ahead.
Quickly, the thing I love about 2019 that's different now is the economy was really hot and the cost of capital was really low. So from that standpoint, generally speaking, I'd rather be in a 2019 world than the world we're in now. But that aside, the other big difference about now is it's going to be a longer runway. And reasons why I think have already been said, but just in terms of being a long-term investor, I'm as committed now as I ever was.
Longer runway in the sense that we have $30 billion of cash. You don't only just have EVs. Now you have energy, AI, bots, and robotaxi, all potentials. But go ahead, Xander, what's your next?
Yeah, thank you. I was just going to echo exactly what Emmett said in my first part of the statement, which is the cost of capital was allowed for the purchase of the cars, as well as the growth of the company. But the second part of it is that you have a company that's worth $40 billion in 2019, and to go from 40 billion to get a 10x to 400 billion, or in the case that it went to 1 point something trillion, that is much harder to do once you're at 500 billion, and then to go to 5 trillion, since no company has ever been valued at that scale. So to answer your question, you would prefer to get in on the early part, and I think the 2019 story was, once the actual ramp and the not the buildings that were built, but the tents that were built, and the issue was solved. Once I saw that the volume was increasing on the Model 3s, that became that moment where, when they became profitable, the company was de-risked. There was no risk for bankruptcy, and that's where I fell in love with the company and bought my first individual stock, was because of that moment.
I think the difference between now and then is, back then, you knew they were working on an autonomous solution, but you didn't have line of sight to it, landing. But you had the auto business growing with the Model 3, and you had, I saw the quote unquote competition coming, but I didn't see anything that was actually there that would have taken units away from Tesla, and you had the TAM growing. So pretty easier back then. Now it looks like the catalysts are like entire industries. Like they have other, like Tesla has now encompassed other industries, whether it's the robotics industry, the AI industry, the energy industry, and now their catalysts are other industries. Where before the catalysts were auto and potentially this robotaxi solution, but I didn't make my investment decisions based off of anything robotaxi. So now I'm looking ahead, and now there's 3 major businesses where they could be highly disruptive, if not leaders in. And so yeah, that causes me to stay long. But I will tell you, I think it's going to be somewhat tenuous for a period of time, because markets have to, they're a weighing machine. They have to understand, like, what is this thing worth this over the next year horizon, year and a half, and what are they going to print in earnings? So it's, to me, when we have these conversations, we become conflicted, or we get to a point where we're talking past each other because we never align on time horizons. If we align on time horizons, the conversation becomes like pretty black and white. Like if we're having a time horizon of 2024, I think we can align on a very, a specific set of issues and challenges, and it's fairly challenging in the current time frame. And everyone's excited about FSD, and I am too. But in terms of it, it printing to the bottom line, that's the transition. I think it's not as well known. But now, if you say your time horizon's 24 months or 36 months, now you're looking at all now you scoop in all those other opportunities, at least getting off the ground and starting, and where the markets would actually value them at something. So I think it's a time horizon conversation, to be honest with you.
2026, just to echo what he's saying, the three things that I think are really critical for us blowing past 420, which is going to pass our all-time high, is the $25,000 car being in volume production, FSD being released, and we're just about there. That one milestone's about to happen, and Cybertruck having completed 250,000 manufacturing in a single year and increasing that run rate. Those are the three critical things that I've been watching for us to pass 420. Everything else is icing on the cake, but I think 2026 is the year that'll happen. Currently, that's my thoughts.
Yeah, so I think what you said was exactly correct. It's about time horizon. So I know Christian's talking about in the next 2 years, but as an investment for me, I guess we're just built different, right? First of all, I invested in Tesla since 2012. I bet on the electric vehicle revolution, which happened. And the car auto industry is a $2.86 trillion size market. Today, we're talking about energy, which is larger than the auto industry. We're talking about robo-taxi, which is 10 times larger than the auto industry. We're talking about bots, which is $44 trillion per year, the potential TAM. And then the complete difference in terms of margins. You're talking about a margin machine that you want to hear again. Right now, we make $17,000 per car, one-time sale. A bot is going to make $100,000 per year in perpetuity. A robotaxi will make $100,000 per year in perpetuity. You're talking just completely different businesses. And so Tesla today is a robotaxi. It's an AI, a robot AI company today. That's what it is. And so, you can argue and say, well, we don't see any of the revenue yet. Until it is, then I won't call it that. That's fair. That's going to be in the next 2 years, and then it will be switched. And so then, it's at your time horizon of investing. Go ahead, Xander.
Hey, Gary, welcome to the stage and welcome to Cyber. I've got a question for you. So what do you think? What did you think of the price action today with the entire sell-off happening pre-market and the rest of the day it going up?
Well, and hi guys. It was less than what I thought it would be, and remember we were pretty negative going into the call or into the print. But you've got a situation where earnings estimates are going to come down tonight, and they released it this morning, so the street was probably talking to clients today rather than doing any research. And so you're going to see the 24 and 25 estimates come down. Let's call it 10% tonight. And then you get, and I think Jeff brought it up, you get this narrative about what should be the right PE if you've got negative growth, and you're going to have negative volume growth in the next quarter as well. I think last year was 466. There's no way they're going to be anywhere close to 466. So you got a narrative that volume growth could be negative for a couple quarters, and so the debate. And my partner and I have this, and we have a pretty low position now. We're 2.7% down from like 10 last year. But what's the right multiple that you put on something where earnings, this will be the third year where earnings are down, and volume growth, everybody's going to take their numbers down. But volume growth is probably 15 to 20%, and earnings growth is 20 to 25%. What kind of multiple do you put on that? And it's hard for me, and I was there in 2019. It's hard for me to put 45 to 50 multiple on something that's shrinking. And so, the question is, can it start growing again later this year? And look, the problem is back in 2019, Tesla was in its own world. There was no competition. And you could, with a straight face, and I used to stand up to the shorts all day long and say, yeah, but they'll turn profitable. And yeah, the Model 3 is out there. Now Model Y is going to come out, and it's not going to cannibalize Model 3, which we were right. Profitability happened, and the stock went up sevenfold because there really wasn't any competition out there. Today, you got tons of competition. Look at what, Xiaomi has just come out with a product, looks like a Porsche. They got 90,000 orders in the first day, and everybody's got an EV today. And so I think the problem is Elon's got this strategy that the car will sell itself, and that was true back in 2019 because they were the only ones there. But now they have to learn how to advertise, and they have to learn how to communicate to separate their products from everybody else's. And I'm not sure they know how to do that. I'm not sure they have the skill set to do that. So we're not buying the dip here. We're just kind of sitting here and saying, look, from a valuation standpoint, the stock feels reasonable at, let's say 2 times growth, but volume numbers are going to come down. Earnings estimates are going to keep coming down. They're probably going to have another volume decline in the second quarter. And until Tesla shows they know how to, do what Apple did, which is really convince people to buy their products, I'm not necessarily where I was in 2019, where every dip I would buy. And now I'm just kind of standing here and saying, okay, it was down what, 5% today. That's probably a little less than I thought it would be down. But on the other hand, there's no compelling reason for me to own this. And I disagree with people who say, well, FSD is here. FSD might be 95% intervention free today, but it's not 99.9, and you could drive a Mack truck between 95 and 99.9. So it's still just driver assist. It's not robotaxi. It may be at some point, but until one can say that there's a robotaxi product out there, I can't put that in my mouth because I'm not sure if we're going to get there, or we're going to get there in a time when nobody else is there. And so that's the hard thing for me when I'm thinking about valuation. I can't just say buy the dip here blindly because I can't come up with a robo-taxi valuation because I'm not at 99.9% intervention free.
Yeah, I like that, Gary. And I would just say real quick, I think the reason it was only down 5% is because if you led into this the last few weeks, I mean, everybody and their mother knew that this print was probably going to be bad, right? It was just about how bad. So I thought if it was even a bad number, it could have rebounded because, I mean, it was essentially kind of priced in where everybody knew something bad was coming. But the fact that it was so bad, it even dropped it 5% down further. So I think the reason it didn't go even more is because everybody was braced for the worst. And you had buyers already knew was going to probably come in and buy that. I think the bigger tell will be over the next few weeks going into earnings, how when people really start to, get this number, how bad this number was, then I think we'll see the strength of the stock or the weakness over the next few weeks into earnings, because that'll show the multiple, because the multiple on a forward basis is still very high. And again, like to you, when you said, and what we've been saying, the growth is not there from an earnings standpoint, from a unit standpoint, from any standpoint. So when you look at it like that, I think everything kind of lines up and makes sense. I really think it'll depend on the earnings and what they say. Like if it's another conference call that we've been used to, again, this is not being mean or being sad or whatever. It's just logic. If they get on the call and they don't explain anything and they say we're doing the best we can and this and that, and they don't give a clear plan of what this year looks like, what the cost of the cars will look like, what the growth is kind of looking like for the rest of the year, some type of plan around FSD to get some software revenue, I think the stock is going to be, a hell of a challenge this year.
One of the problems is that Model Y inventories are at all-time highs. I put out a chart today, some of you probably saw it. The days of inventory outstanding has ballooned from 15 last quarter to 29. And so the question is, what is Tesla going to do about that? And if you look historically, they've cut price. And so my worry is, even though they just raised prices April 1st, yesterday, based on what they've done in the history, they will probably cut price on Model Y, even though they just raised them. And everybody's going to say, well, that was a gimmick then. All you were trying to do was get people to push volume into the first quarter from second quarter by raising price, which didn't work, obviously. And we knew it wouldn't work. But for whatever reason, Tesla was trying this gimmick and it didn't work. So now that it didn't work, will they cut price because the inventories are at an all-time high? If you look at days of inventory outstanding, not all time, but back to 2019, we haven't had DIO at 29. It's been, it was as low as 3, but usually it's been 15, 16 days. And so I think Tesla's going to wind up doing the thing that they always do, which is cut price, because they don't know how to advertise. They don't know how to communicate to ICE owners and say, look, it's cheaper to buy, it's cheaper to maintain, you can charge it in your garage, it's safer, it's good for the environment. They don't know how to do that. And so we're at this situation, the only lever they know how to use to get inventories down is to cut price. And that's not good for the stock if they cut price again. But I think that's what they'll wind up doing.
I'll take the other side of the inventory piece. There's nothing wrong with mid-20s DOI. And as they eventually get into 500 and 600K production quarters, they're going to need to carry more, and they have more inventory locations. Remember, Tesla's opening up new countries and new points of distribution. Every time they do that, they got to fill it with inventory. I think sometimes this gets lost on people, but from a supply chain perspective, there's nothing wrong. And to me, the 15 to 16 days of inventory is undersupplied. If a third of that, you have to think that a third or a half of that is going to be in transit, which means they only have a week of inventory in a 15-day DOI scenario. That's not good. That equates to stockouts and not having something there when somebody walks into a Tesla shop and says, I want to walk out with a car. How do I do that? So I think more and more of their sales model is going to go from direct to consumer to having inventory available to sell, because a lot of people want to make that purchase decision within 1 to 2 weeks. They don't want to wait weeks and months for a car, like it was in the beginning, where EVs were kind of special and they were unique and they were new and they were early adopters. Now you're into the crowd. So it's almost like it's this thing that got us to a couple 100K a quarter is not going to get us to 2 million, 2.5 million a year. It's going to be a different selling approach. They're going to need to carry more inventory. So I think part of this increase in inventory is a supply timing issue, where they had the Red Sea conflict, they had the Berlin issue, they had them at various phases in the quarter. For when they were able to restart production, they had the wrong mix at the wrong time for the wrong points of distribution, and they just got to hold that inventory a little bit longer. I think they're going to flush some of it, but in Q2 and Q3, but I don't think they're going to flush back down to 15 days. They don't need to. If they get down to 20, 21, I think that's totally fine. I think even mid-20s is totally fine, and it's way better than others who make cars. So they'll still have a huge structural advantage, and then they have no dealer network in between that. It's all there. So I'm not. I think the jump from the teens to the mid to high 20s is mostly a one-time issue, but I do think that they need to jump in inventory in order to actually have greater sellout velocity in the coming quarters.
Here's the question,
Well, let's
Jeff.
see what they do.
Here's the question: if they continue to produce at the rate of, say, 450 a quarter, but they continue to sell, and let's just make up a number at 400,000 a quarter, they're building inventory at 50 a quarter, which today the inventory is about 140,000. So what do? Do they just let the inventory pop? Because you say the inventory will flush, but I don't know what's going to cause it to flush. I would agree with you. If they don't take prices down, then my concerns are not valid. But my worry is when you have 140,000 inventory and it's 30 days of inventory outstanding, and they have not been that high since 2019, are they going to cut prices to use your term, flush out inventory? I don't know what other lever they have, right? I don't know what else they can do to flush out inventory.
I go back to Gary. I think the delta from the 15 to high teens rate of inventory to the mid 20s to upper 20s were the three issues in the first quarter. So number one, the Red Sea, you had a 2-week offset in supply, that happened in the first half of February, and then it's corrected and fixed. But the stuff that they need to build, they build certain inventory for certain destination points at certain points in time in the quarter. It's not like everything they build in the quarter can get to an end distribution point in time to be revenue recognizable. So I think they're stranded with some temporary inventory. That we'll have to see what that if that philosophy or if that thought process works out in this quarter. But that's usually what happens when you have a supply disruption like this. The power issue in the factory that was in the beginning of March, and then they come up, and then you don't come up at full rated speed. You come up at a smaller speed, and by the time they come up in mid March, they're at the cutoff point for the quarter, where anything they build may not reach an end point to be revenue recognizable for the quarter. So I think that's two of the issues. And the third issue is on the Model 3 refresh. My guess is they brought in all the part. My guess is they were planning for a 65, 70K quarter for their first launch quarter in the US, because the product runs at 50 to 55K as an old product. So my guess is they were planning a pretty large run rate. They ran into a supply issue. We don't know exactly what it is. Maybe battery related, because the rear wheel drive seemed to be more ready supply. But anyway, so what happens is when they resolve the Model 3 issue, maybe later in the quarter, we don't know if it's fully resolved. Troy said they just started seeing more VIN concentration in the back half of March. But what happens there is you built a bunch of more stuff there that is in inventory. You can't recognize revenue on it, and you got all the parts too. And that threw your 3NY build plans like out of whack. So they got to have a clean quarter of builds. They got to be able to flush this inventory. Yeah, you're right. If the 140 grows to 200K in the next quarter, then there's a bigger issue. But I don't think that that's going to happen. And you even saw them take inventory down from Q3 to Q4 last year. I think when they get a clean quarter of production, they'll be able to flush all this stuff out. But we'll see. But again, I do think that they need to elevate their inventory levels.
Gary,
Yeah.
Gary, I have two demand questions for you. One, how much of an impact will the interest rates going down have on the buying for the American consumer? That's one to go off on with your experience. I really love that insight. And the second is, what do you think it'll take for the Chinese economy to come back so that their demand will start going higher?
Well, the first one, there's been no impact on rising interest rates on demand. Toyota proves that. People are still buying hybrids. And so Elon wants to use that as an excuse, say the high interest rates are causing people to buy. You could buy down interest rates rather than cut price. The company can do that. So that's just a BS excuse that Elon threw out there, and he's going to say it again on first quarter, and people are going to laugh at him because Toyota's not.
Not amongst my peers. And I don't think that's a fair comparison.
Nobody is
Yeah.
saying that. Nobody else is talking about that.
No one else sells
Elon.
direct to consumer, so it's not a fair comparison.
Sure it is. You're still financing cars. If you finance a Ford or you finance...
But you have no visibility on what dealers are doing to
Look, all you
actually
need to do,
incentivize.
you can buy down the interest rate. Instead of cutting price by $2,000 or $3,000 or $4,000, it would have been cheaper to buy the interest rate down to 2.9%. That's a self-inflicted wound. They could have done that, but Tesla doesn't do stuff like that. They don't think like that. So when you say, well, interest rates are too high, that's your own damn fault, because rather than cut price, you could have brought down interest rates. They could have done that. They have $26 billion in the bank, right? So that's their own damn fault. So I have no sympathy whatsoever for the high interest rate argument, because Toyota's not complaining about high interest rates, and they're selling all the hybrids they can make.
But you still can't make a direct comparison because you don't have visibility on what the dealers are doing to help elevate the discounts that consumers are getting at point of sale.
Okay, well, you asked my opinion. I think it's a bullshit excuse, and I've always felt it's a bullshit excuse because no other automaker talks about it. And I hear your point that everybody else has dealers, but everybody finances cars. People finance Teslas, they finance Fords, they finance Toyotas. Okay, so that's just a bullshit excuse, in my opinion. But that's me. On China is a problem because you got everybody and their brother now making EVs. It's 22% of the business is now EVs. You got people without a brand for making cars, and Xiaomi's a perfect example. They make smartphones. They come out with a car and people are buying them. BYD is launching, $15,000 to $20,000 cars as we speak. And I go back to the 2021 fourth quarter conference call when people asked Elon, what are you doing with the $25,000 car? And he says it's not something we're doing right now, and it will go down in history as one of the biggest strategic mistakes they make. And now they're scurrying to try to get a $25,000 car out there. And what it's caused is for them to cut the price of Model 3 and Model Y. And as Jeff said, and I don't know what you do with Model 3. Model 3, they only sold 25,000 cars in the US this quarter. They were going to sell 55,000 because they couldn't make enough. So to cut the price of Model 3 doesn't make sense. To cut the price of Model Y, it's an entirely different price segment. They just don't have a $25,000 to $30,000 car to compete with where the market is at. So I don't know how you compete in China without that. They're going to have to keep cutting the price of Model 3 until they get a Model 2, let's call it, or a $25,000 car, which probably is until 2026. So again, you got the company saying we're in between two growth waves, Model 3/Y and Model 2, as if it's an exogenous event. It's their own damn fault because they didn't launch the Model 2 as they should have instead of focusing on, other things. So I don't know how they fix China because China's not getting any better. It's getting more intense. You got more players. You got a lot of high quality cars, and China I think accounted for about 4,000 of the miss. Model 3 accounted for about 30,000 of the miss. Model Y was about 10,000 of the miss. In Europe, even though people say it wasn't bad, it was about 8,000 of the miss. That's your 50,000 miss. And so Europe, I don't see that getting any less intense. China, I don't see getting less intense. Model Y inventory, it's at an all-time high, and I still think they're going to wind up cutting price again, and that's the way they'll resolve what's happening with Model Y. Model Y is the problem, quite frankly, because it's the best-selling car in the world, and they have an all-time high inventory, and the only way to get rid of that inventory, in my mind, is to cut price, which is going to hurt the stock again.
Jeff, can you comment for just a second on the next generation platform timing issue? That's one that comes up a lot, and Gary's got a point that would it have been possible for Tesla from a supply chain standpoint to actually get the next generation vehicle out any sooner than 2025 based on the type of unit volumes that they are targeting and the amount of not only battery supply, but then, all these other new components that they're going to be putting in it, from 48 volt architecture to the steer by wire system and all these things? Like, how difficult would it be to have delivered that here in the back half of 2024?
Yeah, it would have been an issue. You don't normally launch these new architectures, 48 volt and steer by wire, on something that you want to be the entire volume of your portfolio. Doing that stuff on a Cybertruck at lower volumes, debugging it, having a short quality loop, that's what you would normally do. Tesla could have worked on a defeatured, essentially, if they were to do it earlier, what it would have been is it would have not been an unboxed model, because they're doing ground up fixturing and capital redesign for the factory. So it wouldn't have been, what you would have done is you would have launched a highly stripped down like Model Y coupe or Model 3 variant, and you would have done it with castings, and you would have been able to take the cost structure down pretty precipitously, but it would have been more of just a defeatured vehicle. What Tesla's going for in the compact is, can you actually get a car of pretty much, there's going to be some trade-offs, but essentially Model 3, Model Y type quality, maybe smaller, but the manufacturing method is where they're going to gain the cost advantage. And they're going to also get it through new architectures that wouldn't have existed at the time. So the short answer is it would have been a different product. It would have been a defeatured, smaller, like Model 3. It wouldn't have been the vehicle that they're working on for the coming year. So that's one thing. The other thing, just to get back to the conversation of like what's impacting sales, the other thing just to watch, and and I can't get all this information, but I see it for GM. GM, they grew their inventory pretty precipitously, and they're not calling out a supply issue or supply disruption. So, these, and they're going to 70, 80 days of inventory on a lot of automakers in the US. So we got to be careful that, because they get credit for sale into their dealer network, not necessarily out to a consumer. So we got to be careful with some of the numbers we're looking at just to see if they're apples to apples. And I wonder if there was a canary in the coal mine with BYD, And were they building up a bunch of inventory because they only have a small portion of their business that's direct to consumer? A lot of the stuff they do is in the dealerships as well. So could we know something more about looking at their inventory coupled with their sales and maybe see some trends sooner? There's a disturbing trend definitely in the US with both with new car inventory growing, both non-EV and EV.
Look, the one thing I
So
would say about the Model 2 is we can all say, based on where they are today, you're right, it's a different car. But if they had prioritized it back in 2020, when we and others were talking about it, because it was part of Master Plan 1, and then you had at the end of 21, Elon said, no, that's not our focus. And we howled in protest, and everybody said, just let Elon run the damn company. Well, I'm happy to let Elon run the company, but just recognize that it was something that if they had built a factory in Mexico in 2021 and 2022 and made it a priority to really reduce the cost so that you could sell a $25,000 car, or in China or wherever BYD is building their factory, I just think it would be a different story today because they wouldn't have had to cut prices as aggressively on Model 3. You would have had a true, what they call a flanker product that could be used as a price warrior to match when BYD brings out their lower priced car and Xiaomi has a $29,000 car. And they don't have that today. They don't have something to compete
Yeah.
with all these $29,000
uh,
cars. That's the challenge.
Gary, I hear your point. The only thing I would just say is like for example, the battery supply chain. There was definitely a supply bottleneck in 21 and 22 for batteries, and you also had a commodity ramp going on with COVID. It would have been a disaster to try to do a value car during that time period. I don't disagree with the portfolio need of like, yeah, if you have that slot filled, you'd have a more well-rounded portfolio. I'm just saying in time for 23, yeah. In time for 24, yeah. But I think there would have been severe, not only battery supply issues, but the cost per kilowatt hour was in like the $130, $140 range. You didn't have an EV credit as well. So I don't think the unit economics would have worked. And you would have had a highly defeatured product. That's why nobody had a 25K EV that they could make money on in that time. There's a reason for that. So I think it is a combination of architecture. It's a combination of like what's happened with the supply chain of EV over that time period. And now I think when they do the 25K vehicle, they're going to have a probably $60 per kilowatt hour battery in there. And that will make that'll be one of the key cogs to make the economics work.
Hey
I
guys,
would
great.
agree with that. And I think, to Gary's point, just for a second, that it probably could have been somewhat possible, but it really would have required swinging for some fences in a way that brought the company a lot closer to the edge financially. They would have had to use, quite a bit of that cash pile, and, it would have potentially put them in a position of needing to raise some capital if things kind of broke in the wrong way. And so I do think that the lack of, having the next generation vehicle, there is a marginal impact of that is caused by a little bit of extra conservatism on Elon's part, in the way that he wanted to, manage timing and the cash balance. So yeah, I think that is somewhat fair.
The reason why they needed to wait to do the compact cars because they need to revolutionize and redefine how to do the platform, right? The unboxed models, one of the only ways that you can bring the prices down. And then this argument that we wish that he started it earlier so that we wouldn't be where it is now. Then why didn't you say, instead of doing the Model Y, why didn't they just do the compact car right then and there? It is going to be 3 times the market. They should have done it there. In fact, why do the Model 3? They should have done the compact car before that. The Model 3 is such a small market. I'm saying like you shouldn't, these things about I should have done it and they should have listened to me. That just,
Yeah, but
please, it's a weird
right.
thing to
That's
say.
not Master Plan 1. Master Plan 1 was Roadster, Model S, Model 3, Model 2. And you use the profits from the higher profit generating line to launch the lower profit line so you could expand TAM. And so no, that's just again rewriting history. What they should have done after Model 3 and after Model Y which got them into the CUV segment, which is 40%. Then they said it focused on auto. If you read the book, you read the autobiography, he talks a lot about that we were having debates about should we have a self-driving car instead of a Model 2. And that took up a lot of time. And his team convinced him, no, you really need to have a Model 2 because the self-driving car isn't going to be ready by then. And that was the debate that I think that they were struggling with. He thought that that next generation car was going to be self-driving, no pedals, no steering wheel, no anything. But as we've learned since then, that was a pipe dream, right? It was not gonna happen at the same time frame that he thought it was going to happen. And his team, to their credit, convinced them that they should work on the Model 2 in tandem with, a self-driving car. Because I really think that's what he thought the next generation car was going to be.
Gary, but to be fair, in Elon's calculation, I bet COVID wasn't on the radar. So, and this is a slow moving ship that once you have to divert your path, he couldn't see that coming. But I thought Jeff's point was excellent. I do like your counter that he was trying to move very very quickly. But at the same time, I think that the reality is they're doing the best that they can to navigate and not having the battery supply. They had the demand. And like you said, the master plan was to go down market and exhaust the Model 3 and Model Y demand prior to moving on to the next platform.
Yeah, but what are we really talking about here? I think we have to bring this back to what is separating, bears and more bullish or more bearish people. And I think it's this belief that Tesla's going to get to, some sort of, 5 nines reliable, set it and forget it self-driving solution. And I'm here to say that I don't know the answer to that question because I've never run training on high performance GPUs. These GPUs never existed a year or two ago. I've never seen the rate of improvement when you go from heuristic writing code debugging to having these training models working and solving problems for you in the background. So I just think we're in a whole new paradigm, and I don't know how to put a timetable or a schedule against it. I don't know if we're weeks or months away or what that is. But I don't think any bear could say that either. Like I don't think any bear has. There's no template for this. We were doing all of our work on CPUs beforehand. Now we're doing all this work on GPUs that can process this information tens of thousands of times faster. And then this capacity didn't exist. NVIDIA doubled with TSMC over the last year. So this capacity didn't exist. Now this capacity exists. So I don't think any of us know, are they going to be able to reach the end point, and when are they going to be able to do it? The people that are looking at these releases and looking at the data seem pretty excited about what they're seeing, but I just don't know how to say it's not going to happen. It's a pipe dream, or it's going to happen. And it's going to happen this year. I think that's ultimately what's separating bears and bulls this year is like, where's the revenue going to come from?
Jeff's right. This is the topic we should be using our brains for and our brain power. And there's a big distinction between robotaxi and FSD. But why don't we take advantage of our brains? I'm a certified PMP. I know how to set milestones. One big thing for FSD is level 3, and I'm going to define level 3 really simply. Tesla says, hey, under these conditions, we'll drive the car, and we'll be responsible if the car messes up. So I'd really only feel comfortable doing that as a consumer if Tesla was my insurance company. But let's talk through what it'll take just to get to that level, because that's a huge milestone. And I think it's going to take a while, but we're on a path to get there. Hans, how fast or how long do you think it'll take to get there from your standpoint?
Wait, real quick, Emmett, did you say you're a certified PIMP?
Yes, I did. I just spelled it different.
I know what he means.
Yeah, as far as how far we are out from level 3, it seems extremely close based on what we're saying, that they need to get through the end of 12, if we proceed at the rate that we're going at right now, I think that they could feasibly roll out level 3 by the end of the year. And I don't really think about the value that FSD is adding in kind of a binary way regarding to robo-taxis. Like, the better FSD gets from here, like, there's a minimum viable threshold of functionality that the system has to reach in order for people to want to use it. And up until this point, it really hasn't gotten to a consumer ready product, frankly. But there's a point at which it does. And once it passes that point, then every bit of incremental progress actually is valuable, and it is a value that can be captured depending on how aggressive Tesla wants to be with their pricing. And yeah, I mean, I from where I'm sitting, I would be shocked if we don't see significant flow through to the bottom line in 2025 from FSD as a SaaS revenue product.
Guys, Gary, just a second. I think you guys should read this Washington Post article that was written this morning. Alexandra shared it. Hans and I did a show on it this morning. We're going to publish it tomorrow morning. But basically, you can do robo-taxi today without needing to have any regulation approval. So let me read you exactly what it says, okay? It's a complete opposite of what we all think. It says, by default, driverless passenger vehicles and trucks can ride anywhere in the United States unless a state explicitly says they can't. That means companies can test and operate their vehicles across most of the country. 24 states, including Texas, Florida, Arizona, and Nevada, specifically allow driverless operations, according to Aurora, while another 16 states have no regulations specific to autonomous vehicles. And then the remaining 10, which is California, Massachusetts, and now in New York, they place limits on autonomous vehicles within their borders. So actually, it's the complete opposite. You as a state or the government have to put in regulations to prevent this from happening. But all these autonomous semis, you can have, you can actually go ahead and test it. You can actually go ahead and do this without needing to wait for regulations. The opposite.
Okay, we've been given, hold on, we've been given two really strong points. We've got a date that I think is realistic for the quality of FSD ADAS system to reach level 3. So let's just say January 1st, 2025. But the next point, because it's not just what the car can do, it's what can be insured. When do you guys realistically think that Tesla Insurance or any other insurance company would insure the car to be level 3?
But that's not the point. The point is, at what point does Tesla assume the liability for any damage or injury? Because that's what's going to drive this.
Exactly.
And I think that's the high, Emmett, to answer your question, I think that's the difference between being super bullish and being cautious, right? Like, the way you say it, you're anticipatory, you're sounding excellent about it. Like, this is going to happen. I know it's going to happen. Robo-taxis are going to be so good, and Tesla will take, but think about what you're saying. These things are going to be on highways. I know the system's really good, and I'm not an expert on it, but I'm just using logic. The car has to be perfect all the time, not like once out of every 100 or once every 1,000. It's got to do tens of thousands of trips perfectly in order for Tesla to take liability, because it just takes a few incidents of bad press that could destroy the brand even more, number one. And if Tesla's on the hook for even just like a few hundred, cases of people that are dead, that could really impact the company. So it has to be, for me, again, I'm not an expert, there's probably got to be at least 6 nines, 7 nines on that 99.9. It can't be like 99.99. It's got to be like, maybe like Elon says, the March of nines, maybe 10 nines, 11 nines after that, 12 nines. I could be wrong. I don't know, Hans. Doesn't it have to be like maybe 10 or 12 nines behind that 99?
Not necessarily to generate revenue. That you can have a really good level 2 system that the person is still responsible for, that you can sell through cheaper, but it does need to be really safe.
No, I agree. I was talking about where Tesla took the liability. What would it take? That was Emmett's question.
Yeah.
So I was asking you yeah.
It does have to be really, really good. And insure it for what? To take the liability for level 3, to take the liability for level 4. The nice thing about
Just for
level
level
3,
just for level 3 is the scope.
well, and let me define what I see as level 3, or what I understand level 3 to be. In level 3, I believe you can actually notify the driver that you need to take control of the vehicle within X amount of time. Otherwise, we're pulling over to the side of the road and we're stopping. And in that scenario, it's going to take a lot of data, but we are at a point where we're able to capture so much data so fast. And we're able to train the system so fast right now to make massive improvements. Like the rate of speed of the progress that we're seeing this month is shocking beyond my wildest expectations. That, it's really hard to, it's once again, we're trying to forecast an S-curve. And so I totally get the hesitation, especially of people who are not artificial intelligence aficionados, that Elon says it's going to be this time and then it's not. But the thing that I come back to is that they are finally, like, the architecture that is in use right now is essentially an architecture that, from a theoretical standpoint, should follow the same upper bound limits that Alpha Zero had in learning to play Go. And the way that they can recursively train the system unsupervised, like we've never had the ability to do what we're doing with FSD right now. And we don't know how far that can go. And what we do know is that once AI training systems have reached this point in the past, they have far surpassed the expectations of what the creators of the system thought that they could do. And so honestly, like, the range of possibilities here is that we could be insuring level 3 robotaxis inside of this year. That is well within the realm of possibilities. I wouldn't forecast that because it
It's
seems
not.
like things take longer, but definitely, with, I would say, high confidence within the next couple of years that we are, say by the end of 2026.
I
And
agree with that. And one of the reasons I asked this question is I wanted to expose something, and that is it's taking a long time for Tesla to be able to have insurance across the US. And that's one of the critical milestones. Tesla has to have insurance in all 50 states, or every state where the cars go. Because if we're ever going to get to robotaxi, I sincerely believe, and I may be wrong, but I sincerely believe it, Tesla's going to have to hold that insurance. And we are years away from Tesla being able to insure all the cars in the US, not to mention the rest of the globe.
Excellent point. I didn't think of that. Great job, Evan.
Yeah, but I mean, on that point, I think, and it was brought up, Tesla has stopped going into states. Like when I think Zach was in charge of that, I think they've hit, I don't know exactly how many states, but it's been a long time, and I kind of track it. I don't think they've been insured in another state for like many months, maybe going on a year. So I don't know if they've not worried about it as much right now, and they're just focused on other things. But they
states
aren't
are the
actively
problem.
trying to get insured in other states. I'm just saying that.
That was an accident. Go ahead, Emmett.
Can you hear? Why did everyone get muted?
Accidental. Okay. Emmett, go ahead.
The insurance,
I'll speak.
the insurance is the problem. The states are the problem. In Washington State, the commission is the delay. And I believe that's happening in multiple states. And that's the issue.
Yeah, fair enough. And again, it wasn't a negative point. I'm just pointing out reality. They just haven't moved. That's what I'm saying. I'm not making a judgment. And I'll just say one thing to Hans. Again, I'm trying to get bullish. I want Tesla to succeed, but I'm trying to be logical about it. So when we talk about AlphaGo, I believe that I watched that documentary, and it was chess. So it did get very good. Here's the only difference, and I think it's an important distinction. In that, nobody's going to get injured. Nobody's going to die. If something happens in the game, there is no ramification of any injury or anything like that. So the bar is much harder and much higher. You have societal concerns. You have people that aren't educated. So it's a long hurdle to get to definitely a level 5 robo-taxi than we just think in our head, oh yeah, this is definitely easily going to do. And I'm not saying everyone's saying it's easy, but even when you say, I'm pretty sure 90% in 2, 3, 4 years, we're going to have robo-taxi, I think there's
I
other
didn't say
implications that you have
robo-taxis.
to keep in mind.
Well, can you guys explain to me what Cruise and Waymo are doing today in 7 different cities?
It's really different. And I don't think Hans, and I know I wasn't saying that robotaxi was going to be here in 3 years. I was talking about just the insurance itself. Once the insurance is there, then we have to go through that process and that rollout of under certain conditions, it can be level 5. That's going to
No,
be a
can
process.
you explain to me what Waymo and Cruise are doing today in 7 cities?
The reason why it's so different is because you made a great point, and it's 100% true, that the car company can take the risk and they can do it unless there's specific local or state legislation saying you can't do robotaxi.
Yeah, so who's covered? Who's insurance
Waymo
for
does.
Waymo?
Waymo covers
Okay,
it. Waymo
okay, so
covers it.
they're willing to cover it, but then you guys are all talking about how this is impossible. You can't do it until you have 12 nines behind the 99 before you'll do it. Why?
Because in San Francisco, they do have a bunch of nines behind their 99.
The
Because it's
Waymos?
all
The
yeah, because it's
Waymos?
all geomapped and
No.
it's geo
Really?
no, it's geofenced.
It's because they're
And they,
teleoperated. And so if you got a human that's watching it and actually truly able to they're really being teleoperated, what's happening. But you're
but it's a
telling me that Waymo is
geofenced
99,
market.
12 nines behind the 99s?
I wouldn't say but Waymo is taking the liability if something happens, if there's an injury
Okay.
or the Waymo runs over a kid, they're going to take the liability, and that's what they've told people. But I don't know if Tesla's going to do it. When I asked the question, I was with Tesla a few weeks ago. I didn't get the sense that they're going to take the liability anytime soon.
I doubt that they would have answered your question, right? Unless they told you exactly that, or what did they say?
No, they just said that's not something they're looking at. I just don't
Yeah.
see it happening anytime soon. I'm sorry. It might, but I hear Emmett's point, but I don't see Tesla doing what Waymo's doing, which is accepting liability if there's injury or damage caused by the vehicle, because that is what happens with robotaxi. You're shifting the liability to the owner of the vehicle instead of the driver. And I just and that gets back to the revenue model, that how do you get the driver to accept the responsibility as he is today, which is a driver's assist tool, as opposed to it's an autonomy vehicle. The owner of the vehicle will accept the liability. I don't know how you get from point A to point B. I guess that's my question.
Tesla and these other companies are doing completely different things. I don't want Tesla going down the path of Cruise or some of these other companies, because they're not built for scale, either economically or even the service offering itself. It's going to work in big cities. So, like, okay, Tesla's working on something that could work everywhere. So I'd rather Tesla continue down the path. But I do agree, like, for this to be an imminent thing that you can count on, like, Tesla should honestly be getting on the earnings call and saying, this is what we project for this year. We're going to be level, like Hans was saying, like, we think we're going to be level 3 by the end of this year. And, and that's where we're at. And we're at and here are the interim milestones. I think we're all kind of operating in the dark. I understand why Tesla is doing this. I'm not expecting them to like turn the lights on anytime soon, but quite frankly, we are, from somebody who is like put a mass amount of product out into the field and understands quality systems. we as consumers and investors, we are sitting here in the literal dark. Do we get a chance to use the system pre-launch? Yes. Do we get a chance to see relative improvement? Yes. But we have no idea what's going on with the relative, critical intervention rate, non-critical intervention rate. We don't have any of those statistics. And so it's a bit hard as an investor. And then if the company isn't going to say anything and project of like where they're going to be and give us some milestones, that even makes it more difficult. So I'm in the camp that I'm excited about the improvements. I think none of us understand the rate at which these improvements are going to come because we haven't lived in a GPU training model world in any of our past careers. This is all new to all of us. So I'm in that camp of like, this could be super exciting and super rapid, but then I want the company to come out and actually tell us that and then
Yeah.
and then commit to something.
I guess I just, just listen to what they're doing. Are they or are they not building a robo-taxi vehicle? Has Franz not said since 2019 in multiple interviews since 2019 that the design he's most interested in, most excited about is a robo-taxi vehicle? Have we not already seen in the Walter Isaac's book that they're building this? And in fact, he's walking the line. He's not only, the whole conversation that you brought up, Gary. So do you guys believe that Tesla is going to start mass producing a robo-taxi vehicle if they did not have a plan or some sort of idea of how this is going to be rolled out? Or do you guys are going to just think until you get to 99, 12 nines after 99, it's impossible? Or until Tesla ensures it, which you don't believe that they will. Why would you say that you don't believe that they will?
It goes back to time horizon, Herbert.
Yeah, agreed.
If
But
we're having
my
a
point is,
2027,
yes, that's right. 2027. Nobody said that they're going to do robotaxi this year. Nobody's saying that they're going to do robotaxi next year. But you guys make it all sound like it's an impossible task that will not happen for a decade because of it's impossible to get there. It's just you guys. It's a difficult challenge. I'm not saying it's going to happen this year, but there is a pathway here. There's many. I'm just going to do a show tomorrow with Hans where the states themselves, the Department of Transportation themselves, are supporting and wanting to have autonomous vehicles. They are supporting this. So this notion that regulation is actually fighting against these cars is the opposite. In fact, many of them are jumping to be seen as the first to do this, and they want to make sure. Now, it's got to show proof. It's got to be what Elon has said. It's got to be 5 times. It's got to be 10 times safer than the human, maybe even 20 times safer than the human. That's the metric we need to do, not 99.99999, whatever that even means. Like how many disengagements. That what matters is if it's safer than a human, 10 times safer than human. So let's say humans today across the world across the US kills 44,000 people per year, right? So if it's 20 times safer than that, then you can't kill more than 2,000 people per year. But you guys are saying, oh, if it kills one person. Now, I'm not going to debate that because you're right? It could be this disaster of a brand if it killed somebody. Look what happened in Cruise, right? It killed a person. It drove over a person. It dragged that person. Now, I don't think that person was killed, right? But they were like dragged. But so now they have to shut down and they have to pull back and everything. So that is absolutely a critical issue, but it's not this thing where it can't kill one person. It's got to be like, the safety. NHTSA themselves and the others are actually supportive, and they want to make this because they can see the data today. Otherwise, they would have shut down the 400,000 people. How many, I think Hans and I talked about it. Of all the people that have claimed to have that have died because of the 400,000 beta users that has FSD or autopilot on, almost all of them have been proven to be drunk or driver error. But it's happened. There is a person that died, right? The very first thing in 2018, he hit a semi because he fell asleep or even playing a game on autopilot. So it's happened.
Yeah, no, Herbert, what I was referring to is like, is Tesla going to provide milestones that would increase their revenue, their SaaS revenue this year and even next year ahead of a robotaxi? Like, can they provide milestones around the maturity of the system and commit to those things based on what they're seeing in the lab? Like they have the dashboard, they have the disengagement data, they see what the training models are doing. Like, can they actually come out and inform investors? That was my only request. And yeah, it's 44,000 traffic deaths in a year. So you'd have to light up every car with it. So you're not. So then you have to normalize it down to vehicle fatalities per 100 million miles driven. That's 1.36. And then you look at total miles driven in the US, it's like 3.2 trillion per year. So there's math you can do behind this to understand. I agree with you. It's more of relative safety to what's out there, but that's also a hard thing to convince the public because the public's going to be very wary of robots driving. So the rollout's going to be critical. But I think in near term, like what do investors do for 24 and 25? It's not as clear.
Herbert, you're 100% right. And I want to say this really clearly from a technology standpoint. I'm 100% confident Tesla will reach those safer than a human milestones. I have 100% confidence in that. How long it's going to take, that's the big question. And there's something significant I want to say. Right now, we haven't even reached 98% reliability, meaning across the US, that 98% of the time, it's going to be a completely safe drive. We haven't reached that 98% threshold, so we're not even near March of Nines.
And at 98%, you're not going to sell that many FSD. You're not going to be at more than 10 to 15% take rate if it's 98%. If you're at 99.9%, you might get the take rate up to 40%. But back to the stock price, you're not going to increase the take rate that much at 98%.
I don't know how you know. How would you possibly know that, Gary?
Because people think about it now at being 98%, and the take rate's 10 to 15%.
I don't.
That's what
Gary, I spoke with a machine learning expert yesterday, and he states that we are at one digit of the March of Nines, meaning this rewrite has actually propelled the abilities to the point where you're starting to go down the path of eliminating those corner cases, and I think this conversation it's a great one, and I love everyone's points. I just think like this notion that you have to go through level 3 and level 4 and level 5. Nobody knows how Tesla is going to play it. They could just make it level 2 until it's level 5, and they can incorporate a ride sharing and have the Uber type aspect of it. Like, point is, no one really knows what they're going to do, and the stock can do what it's going to do as a result of the choices that they make. We really can't predict it. I heard someone, Gordon Johnson, say today that Q2 is off to a bad start and that the numbers are going to suck. How does he know that? We're literally on what, day 2?
Gordon Johnson's an idiot, but listen,
Agreed.
he's an idiot.
Agreed.
He's an
Go
idiot.
ahead.
Yeah,
He's an idiot.
he doesn't know. But just to give some granularity real quick, I think we made some good points. I think the average person gets in a car accident. Now, this could be debatable, but I've seen stats. I looked it up. 300, 400, 500,000 miles. So, per that. And then one collision, like a major car collision, every 17 years. So now think about where FSD is now, where we're watching the videos. Could it improve greatly? And could the compute get so great that it drastically? Yes. But where it is right now and where it might be even in 5 years, do we think that Tesla's car won't crash once in every 500,000 miles? Because that's what an average human does now. So the hurdle is very high, even though drivers and most humans are not great drivers. We're pretty good at it, actually, and we don't get, even though there's a lot of fatalities and it's terrible, we're actually don't get in that many accidents. Now, it depends on what kind of driving you are, but I just want to let people know, and I think you do, that the bar to have a robo-taxi, I'm just talking robo-taxi, yes, it could be a great level 3, level 4, but that bar is tremendously high, and it almost essentially has to be perfect, where it wouldn't get in an accident for, a person wouldn't get in an accident ever in their lifetime. I know I've never been in an accident in 40 years. So if you tell me that Tesla could get me in no accidents driving around for 40 years, then I say, yeah, robotaxi. But other than that, I think it's hard to just assume that robotaxi is coming just because we know that it's getting better. I think we need more metrics, like Jeff says, and I think we need more information and data from the company to see what kind of path we're on, rather than just kind of, I agree 100% with Jeff. We're in the dark and we're all guessing at it.
You know, go find 10 people who have gotten the 1 month free that have never driven FSD before. Because I have a few people I've asked, my partner being one of them. And if you ask those people after they drove it, and they all say it's wonderful and it's amazing feat, will you pay $199 a month or $12,000? So far, I have found that very few people are willing to do that. And I'm just saying, go ask the people who are trying it for a month. After they try it, let them drive it for a day or two or a week. Ask them if they're willing to pay the $199 a month, and I bet you're going to find that very few people are going to do it.
Yeah, but I guess, Gary, let me ask you this question, okay?
Gary.
How many people signed up for the FSD beta? Do you agree that it's 400,000 people?
Yeah, sure.
So
I'm not talking about those people.
400,000 people paid for it when it was version 11. Incredibly crappy, right? So this is 400,000 people. Now, it's much better. So with it better, do you expect it to at least double? Or are you going to say, no, it's not going to be
No,
any
but
growth?
those were early adopters, Herbert. Those
Agreed.
are like,
So you're saying
they're
the
people who
400,000
follow
are
this
early
stuff on
adopters,
Twitter.
and then the version
About people who've never
12.3.
used FSD before.
Yeah.
Okay.
Yeah, no, I
And if
understand.
they,
So you're saying the 12.3, they're just not going to adopt it. So because even though it's so much better than 11, 11 sucked, right? 11 had problems left, right, and center. It was
they never used
unusable.
11. They never used 11. These are brand new
I get you.
FSD users.
Yeah, yeah.
And if you ask them, do you think it's a great product? Yeah, I think it's really cool, and it's a technological feat. That's what people tell me who've never used it before. And then you ask them the second question: will you pay at the end of 30 days? Will you pay $199 a month to continue to use it? The answer I've gotten so far is no. Now, I've only been a data of like sample of three, but I bet you if we had a sample of 100, you're not going to have that many people say yes.
Yeah, okay.
Gary, Herbert, I have a good point. So, look, you guys are talking about people's experiences with left and right turns, and the way that I think about it was my wife came home this morning, and I don't have the footage. It timed out in the car, but apparently someone jumped out and made a left turn in front of her. She was going straight, and the car slammed on the brakes before she could respond. Think about that. What happens to insurance rates? What happens to people as they realize that that having this system, and how much would you pay for it, is invaluable? And she came home and she said, "Thank goodness we have FSD. I don't think I saw it as fast as the car did, because in this situation it actually broke before she could."
Yeah, I drove FSD 12.3.3 yesterday from my house to a 10-mile across Seattle and back, flawless. It did 4 things that blew my mind. That made me safer. And it was driving at the right speeds at the right times, going into highways and out. And so, yeah, 4 things it did that. Again, Christian, you've never driven it. You've never tried it yourself. And before 12.3.3, I never drove FSD. I would always play with it. I would test it, but it was never good enough. Anyways, my point is not, you should not look backwards, but you should also not say, oh, it's going to be solved in the future because of this. But yeah, you guys have to understand what neural net is. You've seen what it's done for ChatGPT. You can see how quickly this thing is learning on its own, how fast it's working. So don't tell me that in 5 years it's not going to get to the point that it's ready for getting this. And you can see that the company themselves is making that same bet as well. So just it's if I would not bet against what Elon and Tesla is able to do, and that's why I'm putting my money behind this. If you don't think they'll ever make it, don't put your money behind it. That's fine. And neither of you have put your money behind it. Both you and Gary have decided to not put money today. That's fine.
Yeah, but there's an opportunity cost to that. I mean, if you say 5 years, like what could you be doing with your money in year 1 and year 2?
No, I'm not saying that either, too,
Yeah.
right? So again, we can have that debate too, but I'm not saying that too. I'm just saying that there's when I listen to Christian, it's exactly what I heard my friend tell me just a few years ago, right? He said, robotaxi will never happen in my lifetime. And then now you can watch the car. That same person says, "Oh, will happen, but not in not right now. It'll happen in 10 years." Because you're not able to extrapolate the exponential learning of a neural net and what it's able to do. This car today is already safer than a human. It's supervised. Me using it as a supervised driving, it's already safer than me not using it. That's like I don't drive highways unless I turn on autopilot. I haven't done that for a year because autopilot makes me safer as a driver. Today, I'm now not going to be driving anywhere without turning on FSD version 12.3.3 because it makes me safer as a driver today, supervised. So the chance of
100%
it getting
Herbert.
there, it's going to get there.
100% Herbert. I just want to clarify.
100%,
I'm not
but
saying that robo-taxi won't happen. What I'm saying is I'm not smart enough to know exactly when it's going to happen. That's more. My probability of it, I'm not as smart on that. So it's harder for me to make a huge investment in something that I'm uncertain about. So it's normal. So I respect your position. I'm just clarifying mine.
We've got two people with hands up that haven't spoken yet.
yeah, okay, let's get with you, Vincent, first. You were here earlier.
Hey, hi, Herbert. Thanks. I've been listening to you guys, and I think we are getting too absolute in our thinking. It's either we have it or we don't. I don't think it's going to be that case. FSD, especially, it's like, wow, if you don't have FSD, you don't have robotaxi, it's gone. No, I have made certain points. I think you guys would be able to think better than me. I believe there will be a spectrum, all right? Tesla will be offering different levels of FSD, whether it's FSD for everyday use or Uber drivers or robo-taxis. This will come. Imagine you as an Uber driver driving 12 hours, now you can drive, or driving 8 hours, now you can drive 20 hours with supervised FSD. Would you pay for it? I think they would, because the driver fatigue is a very dangerous thing, all right? And these are the guys that causes accidents on the road. So there is a spectrum. Let's not look at it as such so dogmatic. It's either you go vote left or you vote right. No, it's a matter of how you want to move from left to right or either way. It depends on the needs and depends on the progress of FSD, right? We cannot be so dogmatic and say, oh no, they either achieve FSD or they die. No, it doesn't happen that way. But to be frank, China is catching up and they have lots of autonomous driving and they are also catching up. But the problem is that they are not going to be globally approved for security reasons, for many other reasons. And they're all very much like the other systems that are very fixed, all right? And I'm back with I listened to what Jeff said because he has also consumer electronics experience, just like me. And one critical point we always forget is that shipping costs, I would believe, is very atrocious now, especially car carriers, because the Red Sea issues and all that. Why would Tesla throw away their margins just to meet quarterly numbers? Doesn't make sense to me. If I were Tesla, I said, I'm going to screw it. If I can save a couple of $1,000 not shipping them this quarter and just keep it roll it the next quarter, and I save a couple of $1,000 for margins a car, why not? And I think that's the case. Everybody remembers that one container was like $1,000, became $5,000 during the peak seasons. So we need to understand the cost variations that happen during quarterly moves like that. And if we say, oh no, this quarter is bad, of course it's bad. With all these things happening, how can it be good? If it's definitely going to be a lie if it's going to be good. But I think we have to take it in a very pragmatic and a continuum kind of perspective. I think Tesla's objective is to reduce costs, and that also includes shipping costs. I want to know what you guys think. Am I on the wrong? I think, Jeff, you have the supply chain expertise. But I don't hear of anybody talking about car shipping costs, and that's a waste. We need to understand the car shipping cost because that's into easily thousands per car. Why should they throw it down into the drain? My point. Thanks.
Yeah, Jeff.
What's the alternative?
There's no alternative. Just wait for prices to come down because the peak seasons you got to pay double or triple or quadruple the shipping cost. So I would say if I'm Tesla, I say screw it. I'm not going to meet my quarterly numbers. I'll just ship it next week or next month.
Yeah, Tesla's definitely shifted to a non-expedite. You see the way they closed that quarter. They definitely shifted away from expedite mode to non-expedite mode. So that's going to help them on COGS. What's not going to help them on COGS are units. I think they did close to 500K production in Q4, and now they're down over 10% in Q1. So that may not be as helpful, but we have to look at the shutdown schedule and see. But yeah, they're definitely in that mode. They're not expediting in that, call it that final month. So it seems like they're setting up for more of kind of a service revenue, service margin type model. It's just a question of like, when is that going to happen? And are they going to give investors color on that?
Yeah. And I think that's reflective of what Elon Musk has been saying. He said, oh, now we focus on letting the new buyers do a FSD test drive before they take over the car. So he's slowing down the delivery. If they are desperate to actually increase the numbers for the quarter, I don't think he's going to send out that kind of email saying, oh, please, make sure that they test FSD when they take over the car. It makes no sense.
That's a good point.
No, actually, real quick, let me push back on that. When I picked up my Cybertruck, what they did that was genius. Was they just had a ADAS driver take me about 3 minutes away to the holding lot where my vehicle was, and they had a team staged there, which does increase the COGS. Would do the last minute touch ups or wiping the car or whatever. So it doesn't really slow down deliveries in practice.
Let's move on to Corey. Thank you so much, Vincent.
Thank you.
Hey, thanks for having me on. Vincent stole some of my thunder there. I was going to make a couple points that I feel like in our community we get caught up on the terms a lot, and like the whole idea, kind of like Vincent said, that robotaxi is the be all end all, and I feel like that like sets us back in some of these conversations. There's a lot of room to sell a product here where you can say there's value in some form of autonomy driving. So let's just say it's level 2 like it is now. But if you can say that the accuracy, the disengagement percentage is super, super low when you enter and exit a highway. So enhanced autopilot, right? If you could say that happens rarely, and that a driver, just like the other car manufacturers, they sell like Blue Cruise and all that kind of stuff. We all know that Tesla is superior to this, but there's an idea that you don't have to deal with steering wheel nag, and you don't have to worry about being super anal attentive to taking over, right? That is a huge selling point to a consumer. So before we even get to robotaxi, there is a huge opportunity here for Tesla to make enhanced autopilot at a lower price point once certain levels of functionality are achieved in certain situations. So if you are able to have enhanced autopilot, so I get on and off a highway, but I know that like on certain routes or highways, certain areas, even though FSD will work everywhere, that it will definitely work, and I rarely have to be anal attentive, pay attention to me, or it's going to warn me, kind of like level 3 on highway. Then they could sell enhanced autopilot, give it at a lower price, and have a huge take rate on just that before robotaxi is even ready, right? So that's one piece. I never hear people really talk about this. It's always like, when is robotaxi going to happen? And then everybody argues about it. And some people think 2030, some people think it's going to be next year. I think robotaxi, in my opinion, when I define robotaxi, I'm going to say you could not require a driver to be in the driver's seat, right? And the car will drive and not crash itself. So in order to get to that level, I still think we're like 4 or 5 years at least away from that. But there's opportunity in the middle. Secondly, my second point that I was going to make is there's also, I believe that something like the bot, where can you take and apply the technology and the models being trained? The bot is obviously going to be a huge product that we're going to apply that to. The bot has way less risk than something like robotaxi. So if a bot can do something wrong and can be applied and start learning in a situation, and Tesla can learn from it and start selling some sort of service with it relatively quickly, because they can put it in a factory, a setting, and not have to deal with risk. If it doesn't work in that one thing it's doing, it's not crashing a car and like taking a life, right? So there's a lot of value in a lot of areas and things they can make money on, probably within like the next 2 to 3 years, way before robotaxi is going to be ready. So just a couple points to make. Thanks.
Thanks, Corey. That was great. Yeah, agreed with that. Dr. One of One.
Yes, thank you. I'm an accredited angel investor. I'm looking at stocks, I'm looking at cryptocurrency. If you've been paying attention to Tesla, then you've been paying attention to Elon Musk and everything else that he's doing outside of Tesla, right? So when you're looking at the Tesla stock, which, it almost seems like the Tesla stock doesn't reflect the value in what is going on with everything else that Elon Musk is doing. Why not? Should it be separated, or should the stock, and then also cryptocurrency, right? I mean, Bitcoin. You can buy Tesla cars with Bitcoin. You can buy Tesla cars with Doge.
You can't buy cars with crypto. That's not
You can't
true.
buy a Tesla
And
with Dogecoin. I
there,
mean, with Bitcoin.
no, you can't. I mean, you can, but that's not directly paying to Tesla. And the reality
Not
is, all
anymore.
these
For a
companies
while
that
you
you're
could, but you
bringing up
can't
are
anymore.
separate.
Doctor One of One, you
Yeah.
used to be able to, but now you can't.
Okay, who's
Here's the
next?
problem. Here's the problem from a stock standpoint. If you add up FSD, I've asked the guys in IR this, why don't you break out AI as a separate line item? Because you got autos, you've got energy, you've got charging. Why not just put a line item called AI, put a FSD there, put bots there, anything else, so that investors will pay attention to it? And the answer I got was it's not big enough. And so, if you do the math, if you have 400,000 people paying even $199 a month, it's still less than $1 billion on $100 billion revenue business. So the problem is it's just not big enough from a PE standpoint to break it out as a separate business so that you can get a separate PE multiple on that AI type business yet. It will be at some point, but IR said it's just not big enough yet.
And that's a great point, because ultimately, if you're a short-term stock trader and you're in the 3, 6, 9, 12-month range, it isn't. But if you're looking at the progress that's been made and you're making a longer-term time horizon play where you're looking for a 10x, tell me, where else do you have that certainty? Not that it's a large certainty, but where do you have that certainty built in? And I think that's ultimately, we're seeing that playing out, where you have, a terrible number, but yet the stock didn't crater, which is what most people were anticipating. As well as, I was listening to trading communities that are options players today, and they were saying they were going to short every single pop that occurs, but yet it kept going up.
I like that, Xander. And I love stock. I love trading. I love investing in general. And what I'll say, though, is you have to look at everything. I'll be brief. I know Herbert doesn't like when I get off tangents. You have to look everything in its totality. I understand we're talking about Tesla, but there's a whole world other than Tesla. So Tesla could be a great investment, but as you're waiting year after year after year for something to happen, so I'll ask you the question, Xander, and maybe you are, because the community, some people are like that. What if I told you you're not going to make any money until 2030? And then maybe something happens, right? But it's not 100%, but maybe it's 90%. But I can tell you for the next 7 years, you can maybe invest in some of these other more probabilistic outcomes that you have a better understanding of, and you're going to make money starting next year. Are you just comfortable just sitting year after year after year, just waiting for something to happen? Or are you going to take some action and say, hey, well, let me use my knowledge here and try to figure this out? What might be the best treating my investment dollars over the next 12 to 24 months, which I know everybody thinks is short term, but 2 years is kind of a long time. 2-3 years of compounding money, it could be a lot of money. So I don't know. You have any thoughts on that?
Your crystal ball, definitely 100% without a shadow
No,
of a
I'm not.
doubt,
I'm not
works
talking about
better than
crystal ball.
mine.
I'm talking
Hold on,
general investing, compounding.
I'm just
Yeah.
saying, you can predict it. I can't. The downside to me is much smaller than the upside, and I made money today while everyone is complaining. I bought puts and sold calls, so I'm happy. I've learned to monetize the position, and for me it's fine, and I actually bought shares. So I think that it just depends on your time horizon. It depends on whether you're preserving capital or you're trying to grow your capital.
Fair enough.
People are focused on why Tesla didn't go down before. I do think it's what Christian said before. Stock is down 30% year to date. It's the worst performing stock in the S&P 500. People have been talking about this first quarter being a disaster for 2 months now. Troy's been talking about it since January. So I think the smart money, got in, made the money, and if they sold today, they closed their position by buying, and that's why I think the stock didn't go down that much.
There's one
Why would
big
it?
difference between right now and 2019 as a Tesla investor. We're probably not going to see massive breakout until sometime in 2026. And it's going to probably continue to have this trading range where it gets pretty sweet and then it drops. And that's frustrating unless you want a dollar cost average and just build your number of shares and keep doing that. So in 5 to 10 years, you're on a beach chilling.
But how much pain can you take? The stock's down from 410 to 165. Okay. And back to Christian's point, the market's up probably 30% in that time. And so I can tell you that everybody's going to take their estimates down again tonight. They're going to take their volume estimates down, their earnings estimates down, and the stock will probably go down between now and earnings because people are taking estimates down. And so the question is, why would you want to experience that pain if you could avoid it? And that's the challenge.
I completely agree. Dollar cost averaging is where you buy a consistent amount of money. I know you know this, Gary, but just for the audience, dollar cost averaging is every paycheck you spend a certain amount of money on Tesla stock, and you just keep doing that for 5-10 years straight. If you buy it that way, you don't, when the dips happen, you just get more stock, and when it goes up, you get less stock. But you're accumulating knowing that there's going to be a breakout at some point in the future, but I don't think it's going to be for at least 3 years, or 2.5 at best, but probably 3 to 4.
But doesn't it feel bad if your average cost is 300 and today the stock is at half of that?
Yeah, and the other thing you have to start thinking about is if you start playing multi-year trajectories, then you've got to look at what are the competitive threats and make sure you're properly overlaying what those are. Some of the industries that Tesla's in, I think there's less of a concern. Like, it looks like with robotics, it looks like there's going to be a huge TAM. But you still have to at least understand these dynamics. So I really think it's important in 2024. Like, does Tesla have an AI commitment, for the business on 2024? Is it something that they can talk about? Can they put in the financials? Can they make any kind of projections? I know they're trying to steer away from that, but again, they're seeing data. They have a dashboard of all of us driving, and they're seeing data that we can't see, and they're seeing relative improvement. And there's a reason we've seen 3 or 4 releases in the last month. And this one, people who have developed software before, it's difficult to do this and push it out to a fleet of this size without creating a bunch of other problems. So it just seems like we're on a completely different paradigm where not only are they solving problems quickly, but they're actually being able to iterate more quickly and not introduce new problems. So that's why I just think all these conversations are, and me included, like it's a bit of an ass pull until we understand like the rate of improvement that they're really having on neural nets and just really understanding like here's the endpoint, here's where we're at, here's the rate of improvement we think we're going to achieve. We've interpolated the last, they've been driving 12 since last year. So what data do they have, and what could they share that could be helpful? I just think we're a bit in the dark.
Okay. Well, we tried to do a 2-hour show to see if we can lighten us up a little bit, but I think we have taken our time. So appreciate everybody. We'll do this again next week. Thanks all. Bye-bye.
Thanks.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.